Okay, in the previous lecture, we were talking about the development of the efficient set of securities or assets. So we have all these individual assets and various combinations of those assets create all these potential portfolios. So every one of these is any number of combinations of these smaller dots here. So we graph this uh, with return on the y-axis and standard deviation on the x-axis. So we're going to move forward on to the next slide, the next step in the development of this. And the first thing we do is we identify the minimum variance portfolio. Uh, so this point right here is the lowest variance portfolio available from all these securities. Anything above this line, this point, is the efficient frontier. Anything below this point, the minimum variance portfolio, would be inferior because there would be a portfolio available that offered a higher return with a lower standard deviation, or the same standard deviation. Sorry. So, but anyway, this is the efficient frontier. So, so the return on any security consists of two parts. So, the first is the expected, and then second is the unexpected or the risky returns. So the way to write the return on the stock in the coming month is R is equal to R bar, which is the expected return, plus U is the unexpected part of the return. So any announcement that was unexpected would be the unexpected return. So you might recall when firms make announcements, the market may react positively, may react negatively. The market can react neutrally, and it's all a matter of what investors were expecting the company to say when they made that announcement. So, so any announcements can be broken down to two parts: the anticipated or expected part, or surprise or innovation. So for example, a company unexpectedly exceeding its earnings expectations. This would be a positive. If they unexpectedly missed their earnings expectations, that would be a negative. So you would expect to see a decline. So the announcement is broken down in two parts: expected part and then the surprise. So the expected part of the announcement is the information that the market chooses to form the expectation, the return, the expected return of the stock, the R bar. The surprise is the news that influences the unanticipated return on the stock, or the U. Diversification and portfolio risk. The diversification can substantially reduce the variability of returns without an equivalent reduction in expected returns. We saw this earlier in this chapter, where we had the two portfolios, and once we combined them, we were able to achieve a higher return than the lower return portfolio with a lower standard deviation or lower risk. So reduction in risk arises because of worse than expected returns by one asset are offset by better than expected returns from another. We talked about inversely correlated assets. Or negatively correlated assets. The negatively correlated assets are very valuable in portfolio diversification because they offer the greatest benefit from diversification. So there is a minimum risk level that cannot be diversified away, and this is what is called systematic risk. So the graph here, we have portfolio risk and then graphed against the number of stocks. This is typically around 40 stocks. You can diversify. I prefer unsystematic risk. Most people in the book, they actually use unsystematic risk, but they call it. So as we add securities, the risk level is going to fall, and at some point, and again, this somewhere in the neighborhood of 40 securities, we can eliminate virtually all of this unsystematic risk. The systematic risk is what remains. For the most part, when we talk about this, we're talking about investing in a portfolio in the United States. So the systematic risk we're referring to here is in relation to that. Some of the systematic risk in the U.S. can be diversified away by investing internationally, but that also has its own pitfalls. So, systematic risk is any risk that affects a large number of assets, each to a greater or less degree. Unsystematic risk is a risk that specifically affects a single asset, single stock, or a small group of assets. So we think about you can easily come up with an example for a single company, but say an announcement that affects medical stocks or affects tech stocks, so forth. We've seen a lot of that, a lot of volatility in tech stocks that have taken place recently. So, unsystematic risk can be diversified away. Examples of systematic risk include economic uncertainty, GNP and interest rates, inflation. Any announcement that affects the economy. So, for example, right now the Fed has been very liberal with its policy. It's reduced rates significantly in order to minimize the impact of the pandemic. That activity is a systematic risk. So, on the other hand, announcements specific to a single company are examples of unsystematic risk, or industry. So, we'll continue with total risk in the next lecture.